both of you help me. Hello students, welcome to my class. This is Professor Vincent Usaya, and this is the presentation of part 3 of chapter 6, merchandise inventory. Now here we are going to compare the effects on the financial statements when using different inventory costing methods. Now let's take a look at the income statement. We said that the cost of goods sold is higher under LIFO than under FIFO when costs are rising. Now, what does that mean? Why is the cost of goods sold higher under LIFO? Because LIFO assumes that the units that you bought last were sold first. And usually, because prices of things, normally on average, prices of things goes up, not down for the most part. So if that is the case, then the units that you purchased the last would be the most expensive. And if you make the assumption that those ones were sold first, of course, cost of goods sold will be higher than under LIFO than under FIFO. In such circumstances, as you know, cost of goods sold is an expense. So therefore, the net income will be lower under FIFO than under FIFO. Now, for the balance sheet, when the costs are increasing, FIFO inventory will be the highest. What does that mean? Of course, when costs are increasing, FIFO inventory will be the highest because we said first in, first out. The ending inventory is going to consist of the most recent purchases that we made during the year. Because those prices are higher, of course, we are going to reflect a bigger inventory figure on the balance sheet versus LIFO. Now, here is a partial income statement demonstrating the difference or comparing the four costing methods that we just talked about. All right. So note, FIFO results in the highest gross profit, while LIFO shows the highest cost of goods sold. We just talked about that. All right. The only thing that I just want to bring to your attention here is once upon a time, look at, because LIFO gives you lower gross profit or lower net income. Once upon a time, accountants used to use LIFO for tax purposes because they pay less tax. But then when it's time for them to prepare financial statements for the bank to obtain loan, they use FIFO because FIFO will give you a higher net income or profit. But that is unacceptable now. If you use a LIFO, you have to be consistent across the board. Okay, now moving along, additional comparative results between the costing methods. You can actually look at these very closely yourself. All right. How are financial statements affected by using a different inventory costing method? Basically, a summary of what we just discussed. Now, moving along, let's take a look at lower of cost or market route to merchandise inventory. What does that mean? What does that mean? That is objective 4. Now, we call this LCM for short, meaning lower of cost or market. So this is a rule that requires that inventory should be reported on the financial statement at the lower of the inventory original cost or market. Now, let me just simply explain that to you. Let's assume that you are in the business for selling computers, all right? So you bought 10 laptops at $200. So you wind up paying $2,000 for the 10 laptops. Guess what? During the year, you sold, this is purchase, you sold 7 of the 10 laptops, all right? So you have what? 3 laptops left. How much did you pay for one? $200 each. At the end of the year, it's time for you to prepare your balance sheet. Guess what? To prepare your balance sheet, you have assets, and it's time for you to report your inventory. In quantity, you have 3 laptops left. Don't forget now, you're in the business for selling computers. Now, the question is, what is your ending inventory? 3 laptops, and you paid $300 each. That will give you $600 as your ending inventory. But take a look at this. Now, at the end of the year, if you go back to the market where you normally buy laptops from, and the current replacement cost is now $100, generally accepted accounting principles say you cannot report your inventory for $600. Why? Because you have to apply this rule. What does this mean? Lower of cost or market. So what is your cost? Your cost is $200 a unit. What is the market? What is the current replacement cost? If you go and buy additional laptops, what are you going to pay for them right now? It is only $100 now. So GAAP said, whoa, you now have to report your inventory not for 600, but at the lower of cost of market. Which of this is lower? Of course, $100 is lower. Multiply that by 3, that will give you $300. So your inventory has to be reported on your balance sheet as $300. Now, we could be talking about $300 million now versus $600 million. That would be $300 million difference that you are marking your inventory down by. Because, of course, you love to report, tell the whole world that you have a $600 million inventory. It looks better than telling the whole world that you only have a $300 million in inventory. Now, why would the rule require you to do that? We talked about that extensively in upper level accounting course. At this point in time, all I want you to know is the fact that this rule exists and how to apply this rule. Now, in some circumstance, if we have to report our inventory at the lower of cost of market, then we have to make an adjustment at the end of the accounting period. Remember when we talked about accounting principle, we talked about accounting cycle, different steps that we follow to prepare the financial statement. One of those steps was what? At the end of the accounting period, we have to make some adjustments. So this would be an adjustment to write merchandise inventory down to market value. So in this case, we debit cost of goods sold and we credit merchandise inventory. Moving along, let's take a look at Objective 5. Measure the effect of merchandise inventory errors on the financial statement. Essentially, what you need to know here are just a couple of things. An error in inventory can lead to errors in other related accounts. The other numbers that will be incorrect will be cost of goods sold, gross profit, and net income. I'm not going to bother you with this at all at this point in time. The effect of merchandise inventory errors is going to be discussed extensively in intermediate accounting 1. All I want you to know here is the fact that an error in one period overstate certain accounts and it eventually corrects itself in the third period, and that is basically in terms of the ending inventory. That's all I want you to know right here. We talk about that extensively, like I said, in upper level accounting course. Now, I think that let's take a look at the last objective, or second to the last objective. We are not going to get into periodic inventory system. So the last objective, number 6, using inventory turnover and days sales in inventory to evaluate business performance. Recall, as we said in previous chapters, one of the techniques that we use to evaluate or analyze accounting information, in other words, to help us understand what the numbers really means, one of those techniques is called ratio. As you know, ratio establishes relationship between two numbers in order to give us an insight into a particular issue. So here we have a inventory turnover, and this ratio helps us to measure how rapidly, how fast you are able to sell your inventory. And of course, the higher the rate, of course, the better off you are in terms of how a potential creditor will look upon you as to whether to give you a credit or not, so on and so forth. So that is basically all you need to know here. And there's another ratio here called days sales in inventory. So this measures the average number of days inventory is held by the company. Of course, the faster you are able to move your inventory, the better off you are. So the formula, the ratio is calculated by the days sales in inventory is equal to 265 days divided by inventory turnover, which is the first ratio that we just recently completed. The last objective, we are not going to get into this, is periodic inventory system. As we discussed in chapter 5, the periodic inventory system is a system that accounts for ending inventory periodically, every 3 months or every 6 months or every year, however the case might be. In other words, a running balance of inventory is not tracked on a daily and weekly basis. Because most companies are not able to afford the computer, a lot of companies now use a perpetual inventory system. When you go to a departmental store and buy stuff and they swipe your inventory through the scanner, automatically the accounting system updates their records as to the level of inventory that they have, and all the necessary journal entries are also being made automatically. So again, like I said, we are not going to get into the details of perpetual inventory system. So believe it or not, this is the conclusion of chapter 6 presentation.